when nobody quite believes that something is changing, but prices start moving higher. You know, Bitcoin had a great year in 2023 against most people's expectations, because spring is the time the shoots come up. Then you start transitioning into summer, which is this year, which happens to be the election year, which is when really the debt starts getting refinanced and they have to start using liquidity to finance it. Because
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. After months of maintaining a firm stance despite signs of a slowing economy, Fed Chair Jerome Powell has finally given a strong signal that the US Federal Reserve will be taking a more accommodative approach. Speaking at the Fed's annual Jackson Hole Symposium in Wyoming on Friday, Powell indicated that the central bank intends to start reducing the historically high interest rates in September. Powell stated that it is time for policy to adapt, emphasizing that the direction is clear and the timing and pace of rate cuts will be determined by incoming data, the evolving outlook, and the balance of risks. It remains uncertain how much the Fed will lower its key rate next month. However, most forecasters anticipate a reduction of a quarter in September, with the possibility of another decrease before the year concludes. During his speech, Powell emphasized that the Fed's efforts to reduce inflation are still ongoing, but significant progress has been made. The Fed chair expressed confidence in the sustainability of inflation's return to the Fed's 2% target. Additionally, he acknowledged the current state of the labor market as a factor influencing the rate cuts planned for September. He mentioned that the risks of inflation have decreased while the risks to employment have increased. It appears unlikely that the labor market will contribute to significant inflation pressures in the near future. We are not actively seeking or welcoming any further developments in this regard. In recent months, many experts and influential investors have been anticipating a slowdown in labor market conditions. Despite the Federal Reserve's commitment to keeping rates higher until it reaches its 2% inflation target, there have been consistent predictions about this moment. One individual who has been particularly accurate in forecasting this is Raoul Pal, the founder and CEO of Real Vision. Throughout the year, he has been educating investors about the everything code and why it is high reducing QE and its effect on asset prices, including cryptocurrencies, are key factors in Pal's comprehensive code thesis. And lots of things Raoul Pal discusses, so please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
And what's weird about the everything code, and I'll explain what it is, what's weird is it makes everything so simple.
Too simple.
That most people think, well, this can't be possible.
Yeah.
We kind of knew it in Bitcoin world because we could see a cycle forming, and we've been following this cycle kind of dumbly, well, it's kind of maybe just the halving cycle. We don't really know. And then I started digging in and realized that the business cycle was perfect. So the business cycle, I used the ISM survey, and it was a perfect cycle. I'm like, that's weird, because if you remember, go back prior to 2008, we'd have these long periods of no recession, short periods, and it was variable. But suddenly it's like a metronome, as you say. I'm like, what's that all about? And eventually it led me to realize that 2008, I think, was the Great Reset. The one that people keep expecting happened. What they did is they basically they told everybody they could forego paying interest on all their debts, which was zero interest rates. And then they tried the new trick of printing money via quantitative easing. Now, what that did is allow every single major government in the world to refinance all of their debts on this 3 to 5 year sector. And so they all did it. And what it did was force the business cycle into this 4-year cycle. And then all the asset prices are all correlated. Whether it's tech, whether it's Bitcoin, whether it's the economy itself, it's all driven by the same cycle, which happens to be the presidential election cycle, which happens to be the Bitcoin halving cycle. It's all the same thing. And so when you understand that, it makes the game a lot easier. Now, this is not going to last forever, but for the period of time that we've got, it seems to be playing out perfectly. And you can break these cycles down to 4 phases, which I call the seasons. So we have, call it crypto or macro winter. Well, that was 2022. That was 2018. That was 2014. That is 4 years. The next part of that is spring, when nobody quite believes that something is changing, but prices start moving higher. You know, Bitcoin had a great year in 2023 against most people's expectations, because spring is the time the shoots come up. Then you start transitioning into summer, which is this year, which happens to be the election year, which is when really the debt starts getting refinanced and they have to start using liquidity to finance it, because there's not enough GDP growth to pay for the interest on the debts. And so they keep rolling forwards these debts and they keep monetizing the interest payments, which is this debasement of currency that happens at about, on a globalized level, 8% a year. They're debasing currency. And then next year will be macro fall, and then eventually the cycle tops out and we repeat it again because it's based on the debt refi cycle.
Right.
That this debasement of currency of 8%, there's 2 ways of looking at it. You can say, rightly so, we're being robbed of our future wealth because your future self is getting poorer because you can afford less assets with your income, because income doesn't go up, the assets do because of the debasement. Or the other way is you can say, I'm paying an 8% put option fee on the entire system not breaking, because that's also what they're doing. Because they need to refinance the debt. They need to not let asset prices go too far down. So we can talk about that, but it's another way of looking at it. And you're like, would you pay 8% a year to have the entire system not break? Maybe.
Investors responded positively to the announcement by Fed Chair Jerome Powell that interest rates were expected to decrease. Powell stated during his speech at the annual Jackson Hole Symposium that it was time for policy to adjust. While he did not provide a specific timeline for the rate cuts, his remarks were seen as a signal of a more accommodative stance. Powell emphasized that the current level of the policy rate allowed for flexibility in responding to potential risks, including concerns about the labor market. The topic of employment was a major point of discussion during the week, particularly after a significant decrease in job openings for the 12-month period ending in March 2024. According to the latest data from CME Group's FedWatch tool, market predictions indicate a 0.25% rate cut at the Federal Reserve's upcoming meeting in September. Bitcoin market commentators expressed optimism. Powell goes all in. Scott Noker, the Dove Trader analyst and podcast host, recently shared a post on X where he summarized Powell's quotes. Arthur Hayes, the former CEO of a crypto exchange, made a prediction about the upward movement of BTC liquidations in the crypto market. Popular trader CRA Nuvo also noted the formation of a long wig while analyzing the low time frame. According to the latest data from monitoring resource CoinGlass, there has been a new block of Ask liquidity added at $62,400. This has prevented Bitcoin's price from going any higher, currently standing at $62,000 at the time of writing. The bulls need to focus on the key breakout level in order to successfully turn it into support on the daily time frames. If Bitcoin manages to break through the $62,000 mark, it could potentially signal a continuation of the market rally this week. Michael Vanna Papu, the founder and CEO of a trading firm, has confirmed in his latest analysis. According to Vape, the recent increase in capital flowing into the U.S. spot Bitcoin exchange, traded funds ETF suggests that a breakout is highly probable. The significant inflow observed in the ETF over the past week further supports this expectation. Let's back to the Raoul Pal interview.
Yes, and then pay the interest on that debt, because it compounds every time by the interest payments. So you keep adding debt just to pay the interest payments on the old debt. Now, why is that phenomena there? It's pretty straightforward when you understand it. The US government and all the major Western governments, plus Japan, plus a few others, are about 100% plus of GDP in debt. Now, let's say, theoretically, interest rates are 3%. Well, if GDP growth is at 3%, then all GDP growth goes to pay those interest payments. Okay, But the problem is the private sector is over 100% of GDP in debt as well, and it's got interest payments. So if they both have it, there's not enough GDP to cover it. So what they've essentially done is removed the government debt payments out by printing money. And that stops the whole system becoming illiquid. Because if you think about it, you talked about collateral. Collateral is the money pledged against a loan. If the collateral falls too fast or too far, then you break the covenant on the loan and it gets called on you. And that's the whole system. That's what happened in 2008. So the best thing to do is not let the collateral fall by debasing the currency, and optically it goes up. So it kind of stops the system imploding. It was less of a debt cycle and more of an equity cycle. The debt cycle in 2008 really was the kind of end of the financial system. It was the point that we all knew was coming, which is like, you can't have this much leverage. And if the collateral, which happens to be house prices, which is not a volatile collateral, once that starts, it put a collateral call on the entire system. And faced with the entire blowing up of everything, they decided to stop it. Now, I don't think they quite understood what they were doing at that point. But then Europe had the same issue in 2012, 4 years later, this 4-year cycle. Then Europe, the governments couldn't pay the debt. Okay, now this was a sovereign crisis of giant nations. And Draghi said, I'll do whatever it takes.
Right,
and what that was, I will debase the currency to stop the collateral falling so we can shore up the system. That then magnified the whole thing.
It is worth mentioning that the S&P 500 is currently trading at a level that is only 1% below its all-time high. Additionally, gold, which is often regarded as a reliable store of value, recently reached its highest point ever on August 20th. In contrast, Bitcoin is still 16% lower than its historical high of $71,943 in June 2024. This difference in perception of risk contributes to the discrepancy. Stocks provide stability through dividends and solid financial positions, while gold is seen as a safeguard. Meanwhile, Bitcoin is still grappling with its role as an independent asset with diverse uses. According to CoinShares, the global gold ETF holds $46.25 and ETNs total $66.6 billion. Despite the inherent qualities of Bitcoin, such as censorship resistance and a fixed monetary policy, it still has a lot of ground to cover in order to establish itself in traditional financial markets. This difference in risk perception helps to explain why the increase in gold's value to $2,531 did not have a similar effect on Bitcoin's performance. Although investors are undoubtedly worried about the US government's fiscal debt and are looking for security in limited assets, many are not yet prepared to fully accept a separate digital currency. However, the recent increase in investments in spot Bitcoin ETFs indicates a hopeful direction for the future. These instruments attracted a net inflow of $226 million during the 4 trading days ending August 21st, suggesting a rising interest once initial obstacles are overcome. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.